Hi everyone, thank you for joining us today. My name is Jia Xuan from Syfe's advisory team, and I will be the moderator for today's session. Joining us today is our head of investment advisory, Ritesh, as well as the co-founder of personal finance blog, TheInvestQuest, Peter O. So Peter has actually previously worked at JP Morgan and HSBC as an investment advisor, serving multiple family offices, corporates, and high net worth individuals. And with a personal quest to improve financial literacy of the general investing public, Peter has set up the InvestQuest, which is one of the most popular financial blogs in Singapore, providing content across a huge range of topics, ranging from stocks, bonds, REITs, ETF, etc. They even have like a tutorial platform that actually provides very useful information about investing. So we are really honored to have Peter to join us today. So along the way, just feel free to raise any questions along the way via the Q&A box below, and we will be taking some pauses during the presentation to address that. And without further ado, let me now hand this over to Peter, who will be sharing with us some tips to plan for our investment journey in today's session. Over to you, Peter.
All right, thank you so much for the kind introduction, Jia Xuan, and it's really a pleasure to be here today. So just to give you some semblance of what we have written about for the InvestQuest, just now you did mention we try to be as holistic as possible when it comes to writing our investment content. So these are some of the articles that we've previously written. We cover a range of topics such as the ultimate ETF list for Singapore investors, private equity, the best savings and fixed deposit alternatives, the guides to CPF, derivative strategies, bonds, and even obviously robo-advisors as well. So today I'll be sharing two key topics, right? The first would really revolve around finding the ideal investment approach for you as an individual investor. I'll be talking a bit about dollar cost averaging versus lump sum investing, right? We'll go through the pros and cons of each of these very, very popular investment approaches to really find out which is more suitable for you as an individual. We'll also be looking at the value of timing the market. Subsequent to that, we'll look at what investment vehicles should an individual investor be looking at, right? And we'll look at questions such as, if you're single stock portfolio, how many stocks should you be holding? And if you are investing in ETFs and unit trusts, is there really a difference? And based on different asset classes, is there one that is more preferable for your portfolio? So without further ado, let's go into finding the ideal investment approach for your portfolio. I'll first cover an introduction to dollar cost averaging first. So it's a very popular concept and it's very simple it's very simple. It just involves investing a fixed amount of money into a particular investment at regular intervals. So typically that will be done on a monthly or quarterly basis. And over here, I've listed some of the key benefits as well as some of the disadvantages that go along with dollar cost averaging, right? So in my personal opinion, one of the biggest benefits is really it allows you to remove the emotional bias out of investing. So if you take for example, in March last year when the stock market was down by 30%, but you just try to recall what was your feeling in that kind of situation. Did you take any action for your investment portfolio, or were you a bit too worried, a bit too concerned that there was a bit of investment paralysis at that point of time? If you're the kind of person who gets quite worried when the market is down by 20 or 30%, potentially dollar cost averaging might be a very suitable approach for you because it instills a very systematic and disciplined way to phase in your capital into the market. A second benefit of dollar cost averaging is generally viewed as a slightly lower risk approach because you're not committing all your capital into the market all at once, whereas you are gradually phasing in your investment. But of course, this is also a double-edged sword because it would mean that you're going to be less likely to get a very outsized return, right? You wouldn't be committing a lump sum into the market when it's down 30%. You'll be controlling your investments and phasing in over a period of time. And a second disadvantage it's not really a disadvantage, but more of a feature to dollar cost averaging, is that it's not a substitute for finding a good investment. So if you dollar cost averaged into a stock that's on a multi-year downtrend, right, you still won't be making any money. So in this next slide, I'll go through an illustration of how dollar cost averaging would work in practice. So over here, I put down a hypothetical stock and its stock price over a 6-month period. So in January, the stock price is $10. In February, it's $8, and so on and so forth. And if you take a look at the simple average, the average stock price was at $10. So if you employed a dollar cost averaging strategy, investing $1,000 into the market or into this stock every month, you have invested $6,000 over this 6-month period. And in terms of number of shares you have purchased, in January, when the stock price was $10, your $1,000 investment would have purchased 100 shares. In February, when the stock price is $8, your $1,000 investment will have purchased 125 shares, so on and so forth, right? So when you tally up all the shares you have purchased in these 6 months, you have purchased 616.7 shares. So this might be a bit counterintuitive to many people because they know that they invested $6,000. They know that the average stock price was $10, right? So they'll be thinking that they should only have bought 600 shares. But the beauty of a dollar cost average strategy is that you're buying more shares when the stock price is low and buying less shares when the stock price is high, such that over time you are able to accumulate slightly more shares. In this case, you accumulated 16.7 more shares, such that your average cost per share is now $9.73. So of course, this is a hypothetical situation. And then investors might then be asking, what would have happened if they did it on the Straits Times Index, right? In actual reality. Next, I've plotted the 20-year price chart for the Straits Times Index. And you can see that the average index level was at 2665. And if you had invested using a dollar cost averaging strategy on a monthly basis into the index over these 20 years, your average cost would actually be represented by the green dotted line, right? So it's significantly lower, right? More than 200 points lower at 2,460. So we do see that there are benefits of using a dollar cost averaging strategy, but is it really the best way to get the highest return possible? In this next slide, I'm showing the results that was published by JP Morgan. They looked at the S&P 500 index over a 30-year period using different investment horizons, like 1 year, 3 years, and 5 years. And the conclusion for their study is that roughly 70% of the time, a lump sum investor actually outperform a dollar cost average investor. And the rationale for that is actually very simple. If you think about the stock market, it tends to be upward trending in nature, right? So if you manage to invest a lump sum earlier on, right, you manage to benefit from the compounding of returns over time. Whereas if you are trying to average into the market as it's going up, you're more likely to underperform the lump sum investor. So in summary, we do say that lump sum investing tends to result in higher returns on average, but this also comes at a price, right? Assuming you invested a lump sum in October of 2007, right before the global financial crisis, it would have taken you 5.5 years to recover your principal, assuming you invested in global stocks. That means that only in 2013 would you have recovered your principal and gotten back 0% returns during this entire investment period. So I think for many individual investors, when you're considering whether to use a lump sum investment approach or a dollar cost averaging approach, you do have to think about several factors, right? There isn't a very clear-cut case. It's very dependent on your personal circumstances. So over here, I've listed down 4 key factors that you can consider, right? One of them is, the first one is, what are you planning to use your savings for? Right? Is the investment savings going to be used for an expense that is not compromisable to you? For example, are you planning to use it for your wedding or to fund your, your first house purchase, or is it for your child's education, college fund education? And this could be expenditure that to you is not compromisable on. If that's the case, you might want to consider a slightly lower risk investment approach, which would favor a dollar cost averaging strategy. A second factor to consider is what's your investment horizon. If you're investing right now for your retirement that's in 30 to 40 years down the road, you know that even if we meet with a short-term recession, right, you are still able to recover your principal and compound returns after that, right? So the longer your investment horizon, the more it would favor a lump sum investment approach. The third factor to consider is, are you planning to invest your portfolio entirely in stocks, or are you planning to invest it in something that's a bit more balanced in terms of risk, where it comprises of bonds and stocks. If you're planning to be a very aggressive investor and go with a 100% stock portfolio, you might want to complement it with a slightly lower risk approach, which would favor dollar cost averaging. And last but not least, do you have a current view of the market, right? If you think that the market is currently very overvalued, it wouldn't make sense for you to be deploying a lump sum into the market right now. It'd be better to be diversifying your risk over a longer period of time using dollar cost averaging. So many investors who use a lump sum investment approach do so because they like to time the market, right? They have a mentality of buy low, sell high to make their profits. So over here, I've plotted a price chart of the S&P 500. And you can see on the right side, we're approaching new record highs. And for investors with a buy low, sell high mentality, they will be thinking, is this the time to be taking profit on their position? The secret to this chart is it doesn't show you the chart over the last 1 year. It shows you the performance from June 2001 to June 2013. And investors in June 2013 were faced with a very similar situation as what we are currently facing, right? Markets at all-time highs. Is it time to take profit? June 2013 is represented by the yellow section, the right side of the yellow section on this chart. And for investors who actually decided to take profit at that point of time, they would have really missed out on a very big bull market rally, right? Which is more than doubled the S&P 500. So I think, from my personal perspective, a buy low, sell high approach doesn't work very well on a stock index because a stock index tends to be upward trending in nature rather than mean reverting. So if you can see from 2013 to today, it is not uncommon for the stock index to hit new record highs every year. And if that's the case, it would also imply that if you're a long-term investor, trying to time the market might not be that effective. In this next example, I do want to illustrate what is the actual value you can achieve by being the best market timer as opposed to being the worst market timer, right? So in this example, let's assume that both investors invested $10,000 annually into MSCI World Index over a 20-year period from 2001 to 2020. So cumulatively, both investors invested $200,000. The best market timer manages to invest at the bottom of the market each year, and the worst market timer invested at the peak of the market each year. So obviously, the best market timer is very happy because he achieved a 10% per annum return on his invested capital. And at this juncture, why don't you try to make a guess, what did the worst market timer manage to achieve? And it might surprise many people that the worst market timer still managed to achieve 7.6% per annum returns, right? Such that his $200,000 cumulative investment would have grown in value to $450,000. For many of the viewers today, some of you are in your 40s, 50s, 60s. You have been investing in the market for the last 20, 30 years. Have a think about whether your portfolio has managed to grow at 7.6% per annum. And I think there is a high likelihood that it might actually not have even performed 7.6% per annum. And the reason is because as human beings, we tend to be very emotional creatures, right? When we see that we have a stock in our portfolio that is up by 20 or 30%, sometimes you do get tempted to take profit at that point of time. And as a result, we are very often underinvested to the market. And obviously, conversely, when we have a stock that is down 20%, we also, even though the fundamentals are not good, we will still also not cut loss on those positions. And in so doing, we can then still underperform the worst market timer. So I think at this juncture, a key takeaway really is time in the market is more important than trying to time the market. So now that we have covered a bit on the ideal investment approaches that you can consider for your personal portfolio, the next section that we'll be talking on would be on what are the ideal investment vehicles you should be using, right? We'll be looking at how many stocks you should be holding, and also is there really a difference between ETFs and unit trusts? So if you do read academic research on stock investing, you would have come across many books that says that you should hold at least 30 stocks or more to truly benefit from diversification of your portfolio. And the reason they say so is because when you're investing in a single stock, you're actually taking two different types of risks, right? One risk is called systematic risk or market risk. It could be the risk of a pandemic, a war, changes in inflation rates, changes in interest rates, and this will impact all the companies within the market. And these are risks that you can't diversify away. But the second type of risk that you take when you invest in a stock is called company-specific risk, which could include, let's say, fraud within a company, a fire that's happening with one of the factories of the company, or maybe a negative earnings announcement by the company. And these are risks that you can actually diversify away if you have a portfolio with, at 30 stocks or with more than like 30 stocks. And the reason for this is because, when you face a negative surprise from one company, one stock within your portfolio, over a prolonged period of time, this is most likely going to be offset by a positive surprise from one of the other stocks they are holding within your portfolio. So with this offsetting effect, you are then able to reduce the company-specific risk within your investment portfolio. So I would say that in general, holding 30 stocks or more is good investment advice, but is it very practical for individual investors? Just from an administrative standpoint, if we assume that each of these stocks issues one corporate action a year, it would mean that you have to answer one letter every other week, right? So for an individual investor, this might not be the best use of your time, especially if you have a full-time job, you have a family at home to take care of. So I think a good balance would be potentially to have 50 to 80% of your portfolio invested in slightly more diversified vehicles, right? It could be ETFs, it could be unit trusts, it could be robo-advisors, and maybe the remaining 20 to 30% of your portfolio being invested in single stocks that you are most highly convicted about, that you track very frequently. So if you agree with this kind of mentality, the next question you'll be asking is, for this 50 to 80% of my portfolio that's invested in diversified vehicles like ETFs and unit trusts, which is actually better? What should I be using? If you go and Google the answer, it is very likely that you'll come across articles that says buying ETFs is better because it is generally more cost efficient, and as a result, tends to result in a better performance net of fees. But I think that that's a conclusion that's slightly oversimplified. So in this chart, I want to show you what the analyzed outperformance is for actively managed unit trusts versus passive ETFs by asset class level, right? This research has been done over a 10-year period up to 2019. And in this chart, what we're looking at currently is on US stocks, right? The large caps, the mid caps, and the small caps. If you see that the column is in red color, it means that the passive ETF has managed to outperform the actively managed unit trust on a net of fees basis. But when we expand the range of sub-asset classes to include non-US bonds and stocks, we see that the results are more varied. There are instances where actively managed unit trusts have historically managed to outperform the passive ETFs. For example, within the emerging markets, for high yield bonds, for corporate bonds, these are areas where actively managed unit trusts have actually had a good historical performance, and this is on a net of fees basis. So there are a few reasons why this is so, which I'll cover in the next slide. So the first reason why an active unit trust manager can outperform an ETF is because of index construction methodologies that are suboptimal. So you will know that for most ETFs, their job is literally just to track an index. So if the index is constructed suboptimally, the ETF investor is getting suboptimal investment exposure. So one example could be bond indexes. The way bond indexes are constructed is that companies with the most debt that's issued in the market would have a larger weightage within a bond index. But as an investor, all things equal, I would rather be investing in companies with less debt that's issued in the market. And with this differentiation, a unit trust manager is potentially able to have a slight outperformance by credit selection. A second reason why an active unit trust manager might potentially outperform an ETF is because they are able to manage risk proactively. All right, so for example, if a unit trust sees a company in its portfolio that is not doing so well, potentially it has a potential fraud or potentially going to bankruptcy, the unit trust manager can de-risk the position by selling off this company. But for ETFs, As long as this company is still held within an index, the ETF manager cannot sell out of these positions. A third factor to consider is that that might result in actively managed unit trusts outperforming ETFs is because unit trust managers can typically participate in IPOs, whereas for ETFs, because they are tracking an index, newly issued bonds and stocks don't feature on the index immediately upon issuance, so ETF managers typically can't participate in IPOs. And the last and most important factor in my view is that there might be information asymmetry in certain markets, for example, in the emerging markets or within a high yield bond space. And if you are a unit trust manager with a very strong research team, you have access to information that nobody else has, this might actually be accretive to your investment performance, right? But conversely, in markets which are very efficient, right? For example, in the US stock market, there's a lot of corporate disclosures that are mandatory over there. There's a lot of research analysts that are covering the stocks there. The market is really very efficient. So a unit trust manager is less likely to be able to add value in these kind of circumstances, especially after they are charging their higher management fees. And that's exactly what we are seeing in this previous chart, right? For markets which are generally more efficient, for example, US stocks, your global large cap stocks, government bonds, these are areas where personally, I think that a cost-efficient ETF might be an optimal investment vehicle to use. But in other cases where the market is a bit more opaque, for example, in emerging markets, in high yield bonds, I think there is a place for actively managed unit trusts to outperform. So just to summarize what I've discussed today, in the first section, we talked a bit about finding the right investment approach for yourself, right? We looked at dollar cost averaging versus lump sum investing. In the second section, we talked a bit about which investment vehicles are most ideal for you. Should you be looking at purely single stocks, or is a balanced approach where you're using a mix of ETFs, mutual funds, and complemented with single stocks? Is that more suitable for your personal profile? And if anything, the last but not least, the most important key point is time in the market is more important than trying to time the market. Yeah, thank you for listening in. I think Jia Xuan will be able to have some questions, some Q&A questions to go through.
Yeah, correct. So let us pause here for a couple of questions. So I particularly actually like the slide on the factors to actually consider between lump sum and DCA, because this is actually a very, very common question that clients like to ask us. So there's actually this client who is asking, right? So if let's say he or she actually needs to pay for a house at the end of the year, so I'm assuming less than a year, right? So what do you think that he should be investing? Should he still be looking at like a lump sum or dollar cost average?
I think if it's end of the year, your investment horizon is extremely short, and obviously housing purchases is quite a expense that is non-compromisable also. So if given only these two choices, I would say a dollar cost averaging strategy, but it also depends on what this viewer is looking to invest in, right? If it's going to be something that is very low risk, like an investment grade short duration bond fund, in that kind of situation, potentially you can just use a lump sum investment, right? Because the volatility of that kind of asset class is not high to begin with. But if she's thinking about investing in stocks, obviously, and maybe it might not even be a suitable investment product to be using if your investment horizon is just less than a year, right?
Correct. And I think specifically for goals that need a high probability of achieving it, right? You wouldn't want to be risking the money into really high risk kind of investments. Potentially, you might want to be looking at more defensive kind of portfolios for those.
Yeah.
Let me move on to the second question. Okay, so we actually covered quite a fair bit on, there's no good time to buy, but is there actually such a thing as a good time to sell?
So that's a very good question, right? And I do think that there's quite a lot of investors who say there is no good time to sell, right? The market keeps going up. Obviously, if your investment horizon is perpetual, then you wouldn't even be thinking about trying to take profit. Obviously, there are some people who are more short-term in nature. They can tactically take profit on positions, but those are, I'll say, they're more day traders, right? And they probably do it more on a full-time basis. if you're not doing this, if you really have a job out there, you have family to take care of, your time you're investing in, in trading is kind of limited. I think you're taking quite a high risk in trying to time the market. But obviously, with that said, we all know that on absolute levels, current markets are slightly elevated in terms of valuations, right? So, if you are currently on leverage, you're investing using leverage, it could be a good time to start to think about trimming some of your positions to pay down this leverage.
Sure. That really makes sense. So as a follow-up question to this, right? So if let's say a client was doing DCA, then what would be the exit strategy then?
So the exit strategy depends on the investor's goals, right? We are always, I think now a popular concept is goal-based investing. So for example, if you are investing for your child's college education fund that's in 10 years' time, that would be your end goal, right? You should be investing a part of your portfolio to meet that goal. And maybe that's the time where you are thinking about liquidating the portfolio and hoping that at a point of time, you have a high probability of achieving the goal. But if you're investing for retirement needs, I think you have, for most of us, let's say if you're in your 20s, 30s, 40s, you still have quite a bit of runway. So in that kind of case, you can take a more aggressive approach and just let the compounding of stock returns just do the work for you.
Sure. Okay, good. So I guess maybe, before we move on to the next section covered by Ritesh, right? So potentially, this question can be answered by either of you all. So we actually have a client who is a beginner investor who has been working for 5 years already. So what would actually, be a suitable portfolio or like a asset class for him or her to actually, hold for a long period of time?
So for him, if he's working for 5 years, I'm assuming that he's probably now going to be looking for buying, let's say, a property, right? That could be one goal that's upcoming. He could be thinking about saving some money for his child's education fund that's maybe in 15, 20 years' time. And subsequently, he could have another goal that's for retirement. He could have a split in his portfolio to address all of these 3 different goals. And for example, for short-term needs, he could be looking at investment vehicles that generally have very low volatility. So more recently in the market, there's obviously insurance savings type of accounts. Among the robo-advisors, there's cash management accounts. This could be used to fulfill some of his shorter-term kind of goals. For medium-term goals, he could be looking at a more moderate risk kind of investment. Right? I know that Syfe recently has launched obviously your core investment portfolios, which are more multi-asset based. This could be something that's a bit more moderate risk that could meet medium-term goals. And obviously for long-term goals, you can consider, very cost-efficient type of stock vehicles. I think something that is trending on the net, if you only can invest in, let's say, 2 ETFs, one very popular ETF would be your IWDA, which is ETF that tracks your developed market stocks. And a second very popular ETF is EIMI, which tracks your MSCI emerging market stocks. So you have a very good balance between developed markets and emerging markets.
Sure. That's good to know. And if let's say that's a little bit too confusing for you, I guess Ritesh could also, chip in and see how Syfe's portfolio can actually help to fill the gaps.
Absolutely. Thanks, Peter, for covering a very well articulated topic of, I think both the things, I think 2 main things that stood out for me was lump sum versus DCA and the comparison between passive and active, investment strategies. So I think both of them are very, very relevant. And these are things that we have considered at length when we were thinking about constructing our own portfolios and solutions for our clients. So now let me share my screen and we can go to the next phase of our presentations, right? So just give me a moment. Are you guys able to see this?
Yeah.
Yeah.
Yes.
All right. Great. So I guess before I jump into Syfe, I think it's important to give some background, and I think also some of the points that were covered earlier. It's good to reiterate some of those aspects as well. Generally, I think lump sum and DCA, while people think of them as competing, actually they are very complementary. typically, when you think about your money, you do have money that you have accumulated over periods of savings, and that is money that is beyond your emergency funds. Ideally, if you want your money to work hardest for you, the first thing that you should be doing is investing that surplus cash as lump sum, right? If you're looking at a very long-term horizon and you want to maximize your return, and you want each of your dollar to work as hard as possible, then ideally, the surplus cash that you are having in the bank account, which is beyond your emergency funds, that should be deployed as lump sum. If you're too worried about the markets in terms of timing and all, I think, again, it is a little bit psychological. I think, Peter covered it a little bit earlier in one of the slides as well, that even if you go at the peak of the market, all the time you invest at the peak of the market, still you will end up getting a very high single-digit kind of return, versus if you don't invest at all, that's, I think, the bigger crime. So I think the lesson from this session should be more about getting started with your investment journey rather than, getting too, worked up about, lump sum versus DCA. But if you do want to have a, base level starting point, ideally your surplus cash should be invested as a lump sum. And then on a monthly basis, most of us are professionals. So we have a monthly income and we have a monthly saving. So ideally, those monthly savings is what you should be using to DCA into your portfolios, because these are, regular cash flow that you will have. And again, because you have already kept money aside for your emergency funds, you should really be using these savings to grow your wealth and average into the market as well. If you just do these two steps on a disciplined manner, you will be making your money work the hardest for you, because each cash flow you're deploying as soon as you receive it and you're investing it. So you give that cash the maximum chance to grow over time, right? So I think that's the important thing. The second thing about active versus passive, I think Syfe in general is more of a passive investment house in the sense that we leverage ETFs, leverage in the sense we use ETFs to construct our portfolios. So we use ETFs as building blocks for our portfolios. I do agree with Peter that there are, markets and, certain segments where potentially active managers can outperform because there are inefficiencies in those markets and all per se. Now, again, if we take a step back and evaluate like active fund managers versus passive fund managers, the reason the markets in the US are more efficient is because of the information asymmetry that used to exist does not exist anymore, right? So that's why, it's very hard to beat some of these more developed markets. On the emerging markets fronts and some of the more, nascent asset classes such as bond high yields and emerging market high yield, it is possible for active managers to develop some alpha over a broad-based ETF implementation. But the good news is that now actually there are also implementations which are very nascent. Implementation of ETFs which are very nascent and very targeted. So there are solutions that are available within the ETF universe that you can potentially use to construct fairly diversified portfolios, but also get some alpha, because at the end of the day, what has been proven through research is that most of the alpha that the asset managers and active managers claim to be, something because of their ability to identify undervalued companies and things like that, it's actually more of, they are taking some form of risk because of which they are outperforming. And these have been captured by some of the factors that exist in the market. Like, if you invest into value stocks versus growth stock, typically over a longer duration, value should outperform, small cap should outperform, large cap. So these factors and all have been developed, and now, a lot of fund managers, what has been observed is the reason for their outperformance is not because, of their ability to generate alpha. It's more because they are taking these, specific factor-based risks per se, right? So now let's quickly go into, how Syfe can help, right? So I think generally, in terms of history and vision and how Syfe came into being, we wanted to develop a platform for investors to invest in a very, very easy, systematic manner. And we wanted to remove, opaqueness when it comes to investing. We wanted to remove human emotions and biases. I think this was something that Peter covered earlier as well. We wanted to address, some of these aspects of, why are we investing into actively managed funds, especially as as Peter mentioned, say US markets and efficient markets. when you can get the same or better performance using ETFs, right? So you rather save your fees. Why do you want to pay active managed fees for, getting similar or lower returns using an active fund manager? So I think combining all of those things together is how the vision of Syfe came into being, where essentially we started off somewhere around 2017. We are a CMS license holding company, so we have a fund management license from MAS. In terms of getting started, we actually got started in 2019 with our launch of global portfolios, and since then we have launched a bunch of offerings to a point that now we are amongst the top choices when it comes to investing in a digital first manner in Singapore and beyond as well. In terms of the team, you will observe that it's a fairly experienced team. Each one of us come with tons and tons of experience within individual segments. Dhruv, who is our CEO and founder, was previously the head of ETF trading within UBS. He was the original sort of conceptualization of why we should be using ETF came through him. And then he partnered up with Richard to come up with like the whole portfolio construction aspect of, how should we use ETFs to construct efficient portfolios that are easily investable, and again, removes human emotions and biases from this process of investing altogether, and helps you invest in a very systematic, rule-based manner per se. Nick just joined us. He was previously a fund manager at PIMCO. And then the rest of the team, you can see Sebastian, Akiko, and myself, all coming from backgrounds, where they have had illustrious careers previously as well. And then we have a very big, technology team behind us too. Now, in terms of, just as a company, Syfe, actually, we are a Singapore headquartered company, so we are a local player. Obviously, we have global aspirations, but I think what is more important is from a licensing standpoint, we have this fund management license, which, I think is sort of the gold standard when it comes to, asset managers based in Singapore. So as part of this license, I think what investors get is basically the surety or some sort of safeguarding that their assets are protected to a certain extent. And how do I say that is because of the rules and regulations that govern this license per se. So when someone invests with Syfe, and one big question that we always keep hearing is what happens if for some reason Syfe goes down? How will my assets be held? Will I get back my money? Will I lose it? Those are things that again are addressed through this license, because as part of this, by law, we are required to keep all client money separate from our own money and our own assets. What that means is when you invest through our platform, first of all, your money that you send it to a central DBS trust account, which is called a Syfe client account. It is not our own corporate account. So this is where all client money is first put together. Then from then onwards, when we buy underlying securities on your behalf, those securities are kept with Citibank and HSBC. So those are the custodians of your assets per se. And again, as I said earlier, we, Syfe, cannot commingle our assets with client assets. What that means is, you don't bear a counterparty risk to Syfe per se, right? Not saying that something will happen to Syfe, but I think it is very important to reiterate this point that your money is in safe hands. Now, I think, jumping right into our portfolio offerings, it is important to highlight how our portfolio offerings have evolved over time. I think, Peter was mentioning this a little bit earlier as well, that a lot of people initially get started with investing without really having a goal per se. So they just like, oh, I think I need to do something with my money. Let me start investing. And then, there is a huge, market out there where you don't know where to get started. And there are just too many options out there in the market to, for you to have a conviction in terms of going ahead and investing. And what that happens is, what that means is a lot of us get, analysis paralysis. And in that, we end up not taking any action at all. So our intent with Syfe is to make sure that your job becomes super easy when it comes to investing. And what that means is roughly when you have money and you want your money to work harder for you, essentially there are 3 buckets or 3 segments that you would want to target. Segment number 1 is, savings, right? So typically when you have money and if you just want to keep your money safe and secure, you don't want to take any risk with it or take minimal risk, but you want to maximize the interest that you generate out of it. So, your emergency funds and stuff like that. you would typically keep that money in a savings bank account, right? Now, again, a savings bank account these days are giving interests which are close to zero. So not the ideal case for us to keep a lot of money in the bank. In our case, we have a cash management solution called Cash Plus, which yields 1.5% returns, a projected return of 1.5%. The reason I say projected is because we don't guarantee a return of 1.5%, but because we are investing into high quality, short duration money market and bond funds, they have reasonable prediction in terms of what kind of yield they generate over the course of next few months or next few years. So it gives us reasonable conviction that if you invest into this portfolio of underliers, you will get a return which is close to this number that we are talking about. Again, the fact that you're investing into money market instruments essentially means that you're investing into government or semi government institutions, and these are relatively like 3 months, 6 months kind of maturity instruments, basically meaning that if Singapore government or government bank entities are not going to default, and in 6 months, 12 months time you're getting back principal, you're just keep gonna earn this interest of 1.5%. So again, I think when it comes to savings, typically people want to keep it safe and sound and liquid, but at the same time you want to maximize your interest on it or yield on it. So I think the cash plus portfolio sits pretty well in that bucket, where you can maximize your yield on your cash without really compromising on the risk aspect, right? So that's the first bucket that we usually cover. It's super low risk, of course lower return as well. Now, while you address your savings bucket, it still doesn't sort of beat inflation. If you really want your money to grow over time, you really need to invest your money. What that means is you need to take some element of risk. And within the investment world, then typically people have broad level 2 goals. Either they want to generate some sort of an income from their investments, or they want to grow their investment, or capital appreciation is the primary purpose. So what we have again done with our portfolios is made our portfolios very purpose driven, right? Like when you are investing into something, if you don't know why you are investing, it becomes very hard for you to rationalize when something doesn't go the way that you had expected. But if you really understand that why you are investing into something, it helps you keep your money there and really let the money grow over time to achieve the goal that you have sort of put that money for, right? So now when you look at these two buckets, which is say income bucket and growth bucket, within the income bucket there are actually a lot of options out there. Typically people invest into fixed income or bond based portfolios to generate income. In our case, we have a REIT offering that does give you income, because REITs, by their construction and the way they are regulatory wise set up, they are required by law to give out 90% of their annual or quarterly income as dividends to shareholders. What that means is on a regular basis you will receive dividends from REITs, and that becomes a sustainable way for you to generate income on a regular basis. So we really believe in the aspect of how REITs can generate these regular dividends and cash flow for you, and a lot of retirees actually love the aspect of REITs giving those dividends. So typically I consider REITs to be between bond and equity. They are not as risky as equity, but they are not like bonds as well, because REITs on one side will give you dividends, but on the other side they will fluctuate in value as well. So over time, their returns will be dominated because of the dividends. But if you keep your REIT investments for a sufficiently long time, you can also expect some growth out of it, right? So typically, if you're looking at a pure income kind of a play and some sort of a capital preservation, we have that option wherein you have REITs with risk management, where we combine REITs with Singapore government bonds to give you a relatively lower yield of say 3.25 odd %. But then your money is a little bit more capital protected per se, versus there is a 100% REIT portfolio where the intent becomes more like income plus growth. So you want to get the dividends and maximize that dividend, which is typically 4.5-5%, but at the same time you want to participate in the growth aspect of these REITs as well, right? So that's what the income and growth bucket gets covered within the REITs segment per se. Now coming to more long-term goal planning per se, a lot of us, when we are investing, we are planning for our retirement, we are planning for our children's education. Typically, these are goals for which we want our capital to grow over time. And for that growth, essentially, you need some sort of an equity exposure, right? And what we have done is we have constructed these core portfolios and our equity 100 portfolio to really help you grow your money. Now, depending on your investment time horizon, your personal risk appetite, your goal value that you want to achieve, you can choose amongst these different portfolios. So within core, there is defensive, balanced, growth, and then we have equity 100. And as you can see, there is like different risk levels associated. Typically, I mean, the more red bars is basically means that you are taking extra risk for these portfolios. And the reason for that is essentially defensive has roughly around 20% equity, balanced has around 40% equity, growth has around 70% equity, and equity 100 has 100% equity. So again, if you're a young investor and you're saying that, I don't mind the fluctuations in the stock market, I'm here to invest for the next 20, 30 years, and I'm just contributing on a regular basis. So I want high growth and I will take equity 100 as a portfolio to maximize my return. You can do it. Versus someone who's like, yes, I want some growth, but at the same time, I want my portfolio to grow in a more, stable manner. So then you have choice between your core portfolios, and within that as well, depending on the time horizon and all, you can choose between defensive, balanced, and growth as well. I think one more aspect that I'll quickly highlight within these portfolios is, we, as I said earlier, we have a very strong investment team. And what that means is, some of the points that Peter raised previously as well, we have elements of smart beta embedded within these strategies. So again, when it comes to active fund managers, where they're trying to really pick out winners versus losers, the way we try to generate, some sort of excess returns, we don't really call it alpha, but we call it smart beta, is by really tilting some of your portfolio exposures to certain asset classes or certain segments or certain factors that actually drive returns or long-term returns to equity markets and other asset classes in general as well. So what you will observe in our smart beta methodology, there are factor tilts which are maybe between value versus growth. There is factor tilt between large cap versus small cap, high volatility versus low volatility, and more recently, an emerging market tilt or a China tilt per se as well. So again, the way you should think about Syfe is that we will do the heavy lifting for you. We will construct the most optimized portfolios for you. You just need to choose a portfolio and we automate your investments all through, right? So I spent quite a bit of time here. So let's quickly, cover how do you get started. So essentially there is an app. You can find it in the Apple App Store as well as on Google Play Store. You can download our app. There are different portfolios for you to choose. You can choose one or more portfolios. Even before you create your account, you can see forecast, past returns, all of those things. Once you are happy with your portfolio, you can create your account. And then once you invest, you can track your portfolio on a daily basis, right? So everything is shown transparently to you. We have a very simple all-inclusive pricing structure. There is no gimmicks. There is no hidden charges. We don't, charge you a brokerage fee. There is no entry fee, exit fee. There is no minimum holding period. You can withdraw your money anytime. All the re-optimizations and rebalancings that we do within our portfolios are free of cost. Dividends, I think important thing that was mentioned by Peter again was corporate actions, dividends. All of these are things that might require you to take some action. If you don't, you might get diluted. These all things are basically taken care for you through our investment portfolios as well, because we'll automatically reinvest the dividends. If there are corporate actions, we will take care of them. If there are rights issues, we'll take care of them. You don't need to do any of those, right? And there is no extra charge associated with those. So how do we, charge for all our portfolios? It's a simple a simple fee mechanism. The more you invest, the lower the fees. But the important thing to note is it is a flat, management fee that we charge. So if you're investing less than 20,000, it's 0.65% per year. If it is 20,000 to 100,000, it is 0.5%. If it is above 100,000, then it is 0.4%. Alongside that, we have a dedicated set of advisory teams. So anytime you have questions about our portfolios, about what they solve for you, you can consult with us. And again, we are not incentivized to sell you anything. So we will try to be as unbiased as possible, and it will be more educational in nature as to what is the way for you to start your investment journey on the right foot, right? And again, importantly, on our cash plus portfolio, there is no management fee. So we don't charge any management fee on our cash plus portfolio. I think this is just reiterating some of the points that I mentioned earlier. Some people do ask the question that, I can do it myself. Why should I, like pay this fee and, invest with Syfe? I think these things cover these aspects fairly well. I think the fact that there is no minimum, you reduce, your anxiety of, if you're putting $100 and the broker is saying that, you need to pay $20 minimum brokerage cost, that's, pretty hefty. Versus in our case, there is no minimum, there is no brokerage cost. We do all the rebalancings, risk management, dividend reinvestments, switching between portfolios is free of cost. And all-in management fee is between 0.4 to 0.65%, and there is no add-on to it. So again, I think Jaswin is here as well. So, she's one of our superstar wealth advisors. So please, feel free to reach out to us if you want to get more details about our portfolios and our investment strategies. And I guess there is also a promo code. So, for all the people who have joined in tonight, thanks for spending the night with us. As small token of appreciation, there is a promo code. So you just need to fill up this feedback form, and post that you will get a promo code through which I think you get like a 6-month fee waiver on the first 30,000 deposited with us, I think. All right, so I think, yeah, that's it. So ready for some Q&A. Peter, anything from you, or, does it look all fine?
Sounds good. I'm ready for the Q&A.
Awesome.
Okay, that's great. So perhaps, let's start off with the first question. So a client is actually asking whether or not, should he be buying and selecting like his own ETF or invest in a robo like Syfe, and what would be the key difference? So I know that we covered a lot, but maybe, just a summarized version of this.
Sure, yeah. So I think actually now there are all these ETFs that are very easily investable through your brokerage platforms. So yes, if you have the time and energy to sort of scout through all the different ETFs and create your own investment portfolio, you can do it, definitely. Again, the problem that I see with most of the investors who tend to be investing through their monthly savings is that the investment size is usually small, and when you try to invest those small investment bits through these brokerage platforms, you incur a lot of transactional fees and all. So I think that aspect gets taken care of in our platform, because you just know that every time you put money or take out money, you never have to worry about transaction fees per se, right? Also, I think there are some implicit costs associated with investing by yourself in a DIY fashion. I think we covered some of these aspects previously, but these are like hard costs that you would have to do, that you have to do your own risk management. You have to manage these portfolios on an ongoing basis. So alongside the costs of brokerage and other things, the real cost is also the time that you spend, right? Like, if you think that you really have the time to put in that effort to research and put in the time to identify the right stocks and other things to invest into, you can. But if you can reduce that cost and instead concentrate on your family and other more important matters, and you would rather like a robo-advisor manage your funds and pay a small fee for it, right? And in exchange, you are getting all of these things per se. I think it's not a bad idea, right? Like, you are reducing a lot of your own headache, and there is no guarantee that when you are investing by yourself, you will actually do a better job. So the fact that we are doing the heavy lifting in terms of constructing these portfolios and keeping them optimized all the time, I think there is value to that as well. I mean, we don't have the performance numbers of our portfolios and all right now, but again, you can visit our website and see that how we try to keep our portfolios optimized versus like typical indices, and how our portfolios continue to generate a little bit more positive return compared to broad level passive indices, because of all the elements that we talked about earlier too.
Sure. And I think as like a follow-up to this question, right, perhaps, Peter might want to take the next one, because we know that, he has done a lot of analysis between like the differences in terms of like the robo-advisors out there. So maybe, Peter, you could share with us, what would be the differences between Syfe as well as like the other robo-advisors, and how you would, advise a client how to navigate around this.
So I would say that in general, there are two key categories of robo-advisors in Singapore. right? One of them uses mainly ETFs, which is mainly Syfe's approach. The other would be using mainly actively managed unit trusts, which is the approach for Money Owl and Endow Us. I would say that it, like just now, when I went through the differences between ETFs and unit trusts, there are advantages to using either for different segments of the market, in my view. So I wouldn't say for sure which is better, but I can say for sure that for Syfe, something that you have that other robo-advisors don't have is the REIT Plus portfolio. And initially, when it was first launched, I was still thinking, as an individual investor, wouldn't it be cheaper for me to just buy all the REITs myself? Because it's all listed on the stock market, right? Or even in the other case, why don't I just buy the ETF that's on the stock market? But I did read one of the articles that was published on your site, which did show and broke down the cost of investing in the ETF or buying single stocks yourself. And eventually I did see the conclusion that actually buying through the REIT Plus portfolio was still more cost efficient. At the same time, it still allows you still gives you the diversification across the REIT space in Singapore. So I thought that was something that's a very interesting product that no other robo-advisor currently has.
Right. So thanks for raising the REITs portfolio, because I actually do have a question on that. So with regards to the REITs portfolio, do you guys think that it is still a good investment given the current climate? And if so, whether or not should a client hold until they want to sell it away?
So I can take this question first. So I think for a lot of investors who invest in REITs locally, they are investing because of two reasons, right? The first is income, and the second is they're investing because of the underlying property values within the REIT. So every month, if you go to the SGX website, they actually publish a very useful REIT chart book. And in this chart book, they actually show two very interesting pieces of data. The first will answer the first question about the income question. And it shows a chart of the dividend yields of the S-REIT sector that's in excess of the 10-year Singapore government bonds. And right now, that excess yield is roughly slightly over 4%, and that's more or less in line with historical averages. So from that point of view, you're getting quite fair value on the income space. The other reason why people invest in REITs is because of the underlying property values in the REIT. And one ratio that people look at is price to book ratios. And the reason why people look at price to books is because the book values of REITs in Singapore have to be appraised to fair value at least once a year. So the book value actually is quite a good and accurate representation of the underlying property values within the REIT. And at the current level, the sector is trading around 1.1 times price to book, and historically it's been around 1 time. So again, we are seeing it trading around fair value. So if you're an investor who's investing in the REIT space now, I would say that you are going more for the dividend yield, which in the REIT Plus case will be about 4.5%, but not so much on the capital gains. I've already seen that the market has been quite strong in the last 1 year, right, after the March sell-off.
Right. Any inputs from Ritesh?
Sure. Yes, I think I'll cover it a little bit more from a macro standpoint. So I think over the last few months there have been some hiccups in the REITs market, mainly on back of interest rate movements. So typically when long-term interest rates move up in a fairly fairly aggressive manner that we observed more recently, and that was on the back of fears of rising inflation. So usually real estate and REITs are supposed to be inflation hedges, but if the inflation rises at a very fast pace without warning, that can be a little bit negative. And if that results in long-term interest rates increasing without really growth happening in the economy, that could fairly have a negative impact on the REITs market because their cost of borrowing increases versus the actual growth in the economy is not happening. Occupancy levels are not going up and things like that. So I think that jitter happened close to February and March, but since then the REITs market has recovered quite well. If you compare REITs as an asset class versus say equities over last 1 year or so, the REITs market also went through quite a big correction in March 2020. They fell close to 30% from the peak in February 2020 until March. In terms of recovery, though, I think REITs lagged a bit in comparison to the equity markets. So the equity markets ended the last year at a positive return anywhere between 10 to 20%, versus the REITs market closed flat, for the whole year. And if you compare the February highs, we are even at this point not back yet at the February highs of 2020. So purely just looking at these factors per se, and like going a little bit forward with what's happening around us in the world, generally from a Singaporean context, what I can observe is we are vaccinating our population at a fairly fast pace. What that means is essentially within the next 6 months, I expect most of us to be vaccinated. On top of that, there is more and more leniency that is coming in terms of government restrictions when it comes to opening up of events and places, and as well as like office occupancy levels for individual firms and all. So all of these are particularly positive for the REITs market. If you look at within REITs market as well, there are sub-segments, right? So the two sub-segments that were most drastically affected was the retail and office space. But there are other subsectors which are on a particular growth trend, which is your logistics REITs, your data center REITs, your industrial and healthcare REITs. And the good news is our REIT Plus portfolio is actually fairly diversified and has exposure across these different REIT sectors. It is not just retail and office malls. So what that means is, yes, I mean, at some point of time, these particular sectors which are cyclical in nature might have downturns, but then there are also secular growth trends within the REITs market per se. So I'm fairly positive about REITs. If you're looking at 3 to 5 year horizon, I think REITs were a little bit conservative with their cash flows as well last year, and maybe even a little bit this year. So I do see the REIT dividends also have come down over the couple of years, last 2 years and all. But hopefully over the next 2 years, I see an uptrend in the dividends as well as some price appreciation that you can look at.
Thanks for that. Okay, so perhaps we can move on to the last question for today's session. So we've talked about the REITs market. So looking outwards to the global economy, what would be the outlook for the US market for the rest of the year? Maybe Peter, you want to go ahead with that first?
So I would say that valuations currently are quite fair, right? I think if we look at absolute, I think most people look at PEs. If we look at, let's say, global markets or even the US market, we're not at a very cheap PE valuation. Right now, roughly we're about 2 standard deviations above the historical mean. But there is good justification for that, given that we're coming out of a recession last year. So now we are still in a relatively early stage of the recovery. Interest rates are still low. Central banks are still relatively accommodative. And I think this provides quite a good backdrop. There's a lot of liquidity in the market. In fact, if you look at statistics such as money market funds, there's actually a lot of cash that's still in these money market funds, not yet even deployed into risky assets, right? So we do see a lot of tailwinds. Obviously, the market has already quite a fair bit. So that you should also temper your expectations in the near term, because with valuation at this level, it also does mean that we have taken some of the future returns and brought it forward and gotten it in the last 1 year already, right? So I think right now having a diversified portfolio is quite important, right? In terms of sector views, last year, obviously, a lot of the COVID beneficiaries happened to be the tech sector, logistics sector, and potentially this year, we might see some rotation. And we've already seen some rotation happening, right, from all these COVID beneficiaries back into your, more cyclical, more value type stocks and sectors like your industrials, your materials, your banks. And I think that could continue to happen, right? So end of the day, it's still very important to keep a diversified approach to your portfolio.
Yeah, I think absolutely. I think you've covered it pretty well, Peter, in terms of, my views align very well to what you mentioned as well. The valuations do look a little stretched, but, as you said, with so much liquidity in the market and so much monetary and fiscal stimulus around as well, some of these valuations may be justified now. Of course, there are, short-term market jitters, like, what we observed just in February, March, where, concerns around inflation and all do bring the markets down. But my opinion is, if the interest rates and these stimulus measures remain in place for the foreseeable future, which is say the next couple of years, then this rally can potentially persist. I mean, I don't think we'll get the same kind of rally that we saw, over the last 1 year. But essentially, there is no need to panic as well. And instead, I would suggest, like, each time there is a correction in the market, that those should be used as opportunities to either DCA into the market, or if you have totally missed out on like the last 1 year rally, you should use those as opportunities to get into the market at least. But again, I mean, there is no right time to start, so don't wait forever is what I would say. Create a diversified portfolio, as Peter mentioned, but do get started.
Right. Thanks, Peter and Videsh, for that. So I think with that, we have come to the end of today's session. I hope that, this session has given our viewers better insights into how they can actually construct their own portfolio, and how Syfe portfolios can actually, help to set a strong foundation here to their investment plan. So maybe just a shout out, to our next webinar, our head of investment products, Nick Walker. He will be sharing on the performance on our Cash Plus portfolio, and how a cash management solution is actually an important piece to anyone's personal portfolio. So with that, I think, we can come to an end. Really, thank you so much to our viewers, to Videsh and Peter for joining us. And then we look forward to your continued support and trust in Syfe, and have a restful evening, everyone. Thank you.
Thanks, everyone. Have a good night.
Thank you.
Bye-bye.